All right, welcome back. Today we have another stock analysis. Today we're going to look at Caterpillar. Caterpillar is the leading manufacturer of construction and mining equipment, off-highway diesel and natural gas engines, industrial gas turbines, and diesel electrical locomotives. The number one manufacturer in those categories, a very popular stock, a Dow stock, and then we're going to look at this stock to see the quality of the business. We're going to look at some of the fundamentals, and at the end, we'll look at evaluation to see what we think this stock is worth and whether we can consider this for our portfolio or not. So let's get right into it. Looking at the 5-year chart, Caterpillar has had a consistent growth. Looks like there was a great opportunity to get in at about April of this past year, a few months ago. Great opportunity here. If the pen can work, then we go to go. There we go. Great opportunity right here, April of last year. Right now, market cap is sitting at $187 billion. And then we have a beta of 1.3, so slightly more volatile than the market. Not really what I would expect for a behemoth company like this. But then we have a PE ratio of 19 and earnings per share of 20.48. Currently, dividend yield of 1.56%. Paying about $6 per share for the year. So those are the initial stats. Let's get right into this business to see more about the company. So looking at the business segments, how Caterpillar makes their money. We have 18% coming from their resource industries, 38% from their construction part of their business, and we have 43% in the energy and transportation. So looking at the revenue trends, we have revenues in 2015, 47 billion. Over 2024, we have 64.8 billion. So consistent growth. However, we do have some years that the revenue dropped. Now, this isn't a bad thing. We're looking at about 5.2% growth over the past 5 years. There's a lot of companies out there that are growing faster. However, this company is the leader in their space. They are at the top of the mountain with no signs of anybody throwing them off. So when you have a company like this, you have to expect some years where revenues are not going to grow at all or grow at a high rate, just because whatever market share that's there, whether it goes up or goes down, they're going to grab the most of the market share or whatever shares that's there for them to grab and continue trucking along. So we have 5 years where revenues went down. However, revenues at 47 billion to 64.8. So long-term trend, they're growing pretty steady with a little bit of volatility there as we expect a mature company like this to be. So that's good. Margins, we expect this to be pretty consistent for their maturity, 27% all the way to 36%. So consistent and growing at a pretty solid rate. So margins are growing at a rate faster than revenues. That means as they're maturing, they're making the product for much less, becoming more and more efficient. So we like to see that. That's a great sign to see. Looking at this chart here, we have the blue representing the revenues and the green representing the gross profit. What is left over after they cover the cost of the product, all the costs associated with delivering the product to the customer. So we see this trend here where revenues are trending pretty solid. And then we have a solid trend here for the gross margins. Of course, as we discussed, it looks like this company has a very cycle, 2 years up, 2 years down, 3 years up, and 2 years down again. So it looks like it's a pretty 2 to 3 year cycle, pretty strong 2 to 3 year cycle that they have. But again, look at the trend line because that's what's important. We're not worried about a little bit of volatility year to year. Look at the trend line, steady going up. So great to see this for this business. So let's look at the profits. Here we have 2015, 2.5 billion, and 2024, $10.7 billion. We have net profit margin of 5.3, and it goes up to about 16.7. So again, what we saw with the gross margins, as this company continues to mature, they are having less cost compared to their revenues, which means their margins are growing steady. We have more profit, more cash left over at the end of the year for the shareholders. So we like to see that. Let's look at free cash flow very briefly. 3.4 billion in 2015, 8.8 in 2024. we like to see this. A major growth in 23, had a boom right there in free cash flow. 89% increase in free cash flow, down from there, but of course, still much higher than 22. So we like to see that trend. Let's look at a little graph here of the free cash flow. So we do have this boom here in 22 and down from that time. So not as consistently growing, but similar to what we saw in the profit. You do have a little bit of that 2 to 3 year cycle. But again, long-term trend is solid going up. So we like to see that for free cash flow. Let's look at debt. How much free cash flow is on their books? Are they earning compared to the debt, and how fast can they pay off their debt? If this company were to get into trouble, this is what we're assessing right here when we're looking at this metric. Debt to free cash flow. 2015, 8.9 billion in debt. 24, 27.3. With that being said, over the past 5 years, they keep a debt to free cash flow of 4, meaning they can pay off their debt in 4 years with their current free cash flow on average. So we love to see that 3.3 in over the past 3 years. So we want companies to be under 5, under 3 if possible. That's great, but we will accept under 5. And for this type of business, this is a great leverage position to be in. A debt to free cash flow of 4. Now let's look at the trends of debt to free cash flow. The orange representing the debt, the green representing the free cash flow. We see that though they're both trending up, debt is trending at a higher pace than free cash flow. So that's something to keep an eye on if you're thinking about investing in this company long term. We do have debt rising currently at a higher rate. It doesn't mean that's going to continue. We just notice that for the long term or 10-year trend. So that's something to note. We don't want that debt to free cash flow to get over 5. However, over the past few years, we do have 1, 2, 3, 4, 5, 6. Actually, so 6 years over the past 10 years, they've been over that 5-year period mark. 5-year mark. Over the past 5 years, they've dropped down to 4. And that's a major, mostly due to this past year in 2023 and 2024. So debt is still trending at a higher rate over the long term. So however, over the short term, the past few years, that cash flow has been growing a little bit higher compared to debt. So that is a positive trend. So great leverage position for them to be in. Let's look at their dividend. This is definitely a dividend stock, dividend growth and dividend income for many people. So to my older investors, where this is going to be more important to us, this is what we like to see. So we have a payout ratio of 30. That means 30% of their free cash flow is paid out in the form of a dividend. That doesn't mean they necessarily have the 70% left over for nothing, because as you see, they have to pay off some debt with that free cash flow. And we're going to look at shares outstanding. So there's another form where they can pay out some of that cash flow and benefit the shareholder. So this is one of the ones that we like to see, though. 30% payout ratio, which means they have room to grow it. We have an 8.4, 8.3, 8.1, 7.7. So well above average dividend growth over the past few years. Let's keep going to see what else. We have 19% growth here in 2019, 10% in 2018, a small 1.3% in 2017. But let's continue to look a little bit more. We have 10%, 16, 15, 13. So since 2012, they've had 1 year of minimal dividend growth of 1.3%. Every other year, they've either been double digits or well above the average S&P 500 dividend growth rate of about 5.7%. So this company has a strong dividend, has a lot of room to grow it, and continues to grow it. So they have a commitment to growing that dividend, as we've seen over the past decade or so. And we want to see a company in this position doing that. So that's pretty great. Let's look at the shares outstanding. This is what I love to see. Now, we talked about the payout ratio, meaning 30% of their free cash flow is being paid out in a dividend. What are they doing with that other 70%? It's not necessarily just sitting on their books. They are buying back shares at a great rate. So we want to see the share count go down, and this is what they're doing. So with the share count going down means me as a shareholder, my shares become more valuable because more of the earnings belongs to my shares. As long as the company keeps buying back shares and reducing the share count, the remaining shares become more and more valuable. So you're getting a strong dividend with a strong dividend growth, and the shares that you're holding are growing in capital appreciation. One, because the business is improving and getting larger. Two, they're buying back shares, making your existing shares more valuable. So this is a great trend. Caterpillar is doing it right here. So let's look at the value added. We looked at profit, we looked at margins, looking at their debt and their equity, the amount of money that they have on their books to use for their business to turn a profit. What is the return on that amount of money? So right now, return on capital over the past 5 years, 17.09%, above their weighted average cost of capital. What is the opportunity cost and the interest rate on that debt and equity that they have sitting on their books? Instead of putting that money in a treasury, getting a guaranteed return, what are they going to do? What is the cost of holding that money? 4.18%, creating a value spread of 12.9. That means over the past 5 years, you're averaging economic improvement of 12.9% as an entity by running their operations. So we love to see that spread. Great to see there. With all that said, what is Caterpillar worth? What do we think this company is worth? So we did see that this is a mature company with minimal growth. Again, they're at the top of the mountain, and when you're at the top of the mountain, there's nowhere to really go up from there outside of the industry itself and GDP expanding. So what can you do? 3% a year over the next 5 years. Discount rate of 4.2%. I'm keeping that there because there's not much risk when it comes to this business as far as it losing market share. Terminal value. I believe that if I were to buy this share now, this company now, sell it in 5 years, I should be able to get at least 20 times free cash flow. The market cap should be at least 20 times free cash flow as far as what I get in return. So that's why I have 20, and that's their about average free cash flow multiple that they've had on their books over the past 20 or so years. 8.5 billion in free cash flow right now. That puts me at an intrinsic value of about $413. So pretty much the share price of $398 where they are right now is pretty much smack dab in the middle of what I believe the fair value range of this company is. Again, we're not trying to be exact. We're just trying to be directionally accurate. Is it overvalued, fairly valued, or undervalued? Where does it fall in one of those three buckets? And with that being said, with the quality of the business, are we comfortable with investing in this company right now? With Caterpillar, personally, I would say yes. For reference, right now, 21.2 times free cash flow is where they're trading now. So they're right at that fair value of 20, giving these low growth, but definitely low risk. I believe this is a fair value for them. About $413, definitely not overpaying for a quality business in the leading manufacturer in their space. So let me know what you think about this video in the comments. Let me know what you think about Caterpillar. Is this one that you have? I know some of us dividend lovers, this is one that we always keep our eye on amongst a few others, but let me know what you think in the comments, and I hope to see you in the next video.